And today, these questions comes to me all the time. What can I do to save taxes? Our specialty is to make sure that you are in tax protected, like the IRS is not after you, number one. Number two is you pay the least amount of taxes legally available to us. So there's a lot of strategies, a lot of techniques that we can capture, and you're not doing anything wrong with this, okay? So let's start with, so there's 9 topics we're going to be talking about. The first one is the fix and flip. Second one will be the long versus short-term 1031 exchange, the famous 1031 exchange. We're going to take it to a different level. The 4 is all the rentals and the passive rules, and then the qualified opportunity and depreciation, and then capital improvement and repairs, self-directed IRA. A lot of people have been using it, and gifts versus inheritance. These are the famous 9 topics that we always speak with real estate developers and real estate professionals on these 9 topics. By the way, this presentation is going to be available online. So if anybody want to take the slides, view it again, replay it, by all means, it's going to be, you can speak to Tanya or anybody from this team in here. So fix and flip. The main idea is how to capitalize or how to expand, maximize your expenses. A lot of people, when they buy a house, when they sell a house, they only focus on what expenses goes on, which is the repair. They buy, the repair, they sell. But there's other costs involved that a lot of people do not attribute to that. For example, your home office. You're working and you're developing this. What about your car? A lot of different expenses that a lot of developers forget and overlook into these kind of expenses that related to the home buying and flipping. Believe it or not, a lot of people forget to take the closing cost. And I've seen it so many times. So you're buying or you're selling, and you're selling you're expensing the closing costs, and a lot of people leave this money behind on the table. Second topic is the short and long term. And the difference is 365 days. From the time you buy until you sell, you will save from 37%, you will save to 20% because you kept it for so long. So a lot of people, why can't you rent it for 6 months? Even if you fixed in 6 months, rent it for 6 months and then sell it. So a lot of techniques, a lot of planning in these we can do. By the way, if anybody has any questions, please feel free to interrupt during. 1031 exchange. The 1031, there's a lot of different rules that a lot of people do not know. So the 180 days, there's 2 rules. From the time you do the closing, you count 45 days to identify the property, and you have to name 3 properties. Why 3? Because you just have to close on one of them, okay? And you have 180 days to close, to do the actual closing. A lot of mistakes happen in here, that people go to the closing table without having a 1031 expert, a 1031 person to receive the check. The minute you get the check to yourself, written to you, the transaction disqualified. You cannot do 1031 anymore. It's tainted. So make sure we have your professional ready for the 1031. What we've seen is a lot of people right now selling a house in a 1031, and they cannot find a property to buy. The 180 days is expiring, and every time they get outbid. So we have basically we can do a reverse 1031. A reverse 1031 where you buy first and then sell. So you do the same 180 days but reversed. So speak to your 1031 experts, and basically you can buy. Of course, you need more funding, and then or mortgage, and then once you sell it, the old property you can pay off your mortgage, and that's the exchange can happen this way. There is a rule. It's not working. Can you click? Next slide. Okay. The 200% rule. The 1031, it limits you to 3 houses. You sell 1, you buy 3. Okay. Now, if you want to buy more than 3, there is a 200% rule, meaning you can expand more than 3, but you cannot double in value. If you sell $1 million, you can buy more than 3 properties, but cannot exceed $2 million in gross sales, in purchase price. So that's the 200% rule. If you exceed the 3 properties, and if you exceed both, next slide, please. The 95% rule. So now, if you exceeded the 3 properties and you exceeded the 200% of purchase, now there's a third rule, 95% rule, which is you have to be 95% owner of all properties if it exceeds the 3 and exceeds the 200%. So there's 3 rules. Number 1 is the 3. The safe harbor would be the 3 rules, the 3 property rules. The second is the 200%. You cannot double your sales. And your third, even if you did more than 3 and doubled, you have a third rule. You have to be minimum 95% owner of all property. Keep in mind, a 1031 does not work if it's owned in a partnership. A single member LLC can work because you're sole owner. If it's partnership, a 1031 would not work. We have to plan how to extract the property from the partnership with no tax, so you can own it personally or in a single member LLC, and then we can do the 1031. So there is a lot of planning ahead of you even thinking of selling and listing on the market. You have to plan ahead.
Quick question, Pishoy.
Sure.
What if you haven't closed on a property and you just purchased a new property? Does this qualify?
You have to speak to a 1031 specialist. Try to get it qualified.
Can you repeat the question a little louder so we can hear back here?
Yeah, the question was, if you haven't closed on the property and just purchased a new property, would you qualify?
So what I'm saying is there is exceptions to every rule. So we have to speak to a specialist to how can we get this qualified.
Sure. On that note, so we had a development very recently where it was a commercial multifamily that these developers were acquiring. They were able to use an LP, a limited partner,
Yes.
who actually didn't have to the PG. That limited partner was coming in to own a certain percentage of that entity, and they were able to 1031 those funds.
Yes.
So it is, correct me if I'm wrong, it is possible actually 1031, get an LP, 1031 money into a larger development, even if they're a portion of that equity.
Yes,
Right?
yeah, there is always ways, but the rule of thumb is if your house is owned by a partnership, multi-owner partnership, you cannot sell and buy within the same partnership. This is disqualified. You have to export other options, and there's other techniques that we can do basically to get it qualified. Combining your home with a 1031. This is a very good tool. So somebody sold a house and he did a good, successful 1031 transactions. The first 2 years after the 1031, you have to keep it investment. It has to be invested for the 1031 to be successful. After the 2 years, you can flip it to a primary home. It's fine because you satisfy the 24-month rule. Okay, so for example, you sell a house in New Jersey, and you go buy a house in Florida, and you rent it for 2 years. After 2 years, you can move in it, and that will become your primary residence. It's fine, and this is no problem with this. Okay?
But if I sell my primary
So very good tool
residence, I can
with
do a
that.
1031.
Now, keep in mind that with the 24-month, with the mixed properties, if you come to sell, there is always a portion of the profit and a portion of primary. So it's mixed. We have to separate these two, and that's why some planning is required when you come to sell properties like this.
So you own it for 2 years, you decide to sell, you make capital gain on the first one for profit, so you
Yes.
make capital gain now. You sell in 2 years, you need to cash out. You have to pay the capital gain.
Yes. So once you sell, the deferred gain will be realized. Okay, but if you flip it to a primary home, Now, from that time, for example, let's you buy something, $500,000. You sell it for 750. You made 250,000 capital gain. You sell the 750 in a 1031 exchange. So you have 250 deferred. Now the 750, 2 years later, you moved into it and you lived in it. Now it's $1 million. Okay, so there's 250 from a 1031 and 250 while you're living in it. So the second 250, that's exempt because that's primary residence. The first 250, that's taxable because that's a 1031 deferred gain.
Pishoy, we have someone wanting clarity on the reverse 1031. Basically, you purchase a property prior to closing on a 1031 exchange.
Yes.
And then once it closes, you're able to reimburse yourself for the costs incurred during acquisition.
Yes. So basically, you buy first with all the fees and everything, and you close on it, and then within 180 days you sell, and the proceeds from the sale pays for the reimburse you for all of this money. So you get this money back. 14-day rule. 14-day meaning you can use a rental property for 14 days without affecting its investor status. A 1031 only works when the property is an investment, rental or flip. Okay, a 14-day rule, that means you as an owner, you can use the property for 14 days without affecting the investment status of the property. If you exceeded the 14 days, a 1031 is disqualified because considered primary home. You cannot do 1031 on a primary home. So that's why people buy a lot of properties, and like 14 days here, 14 days here, 14 days here. He has multiple vacation throughout the year.
That exclusion, that excluded if you live in a multi-family home where you occupy one of your residences, but the other two are considered investment.
So yeah, so multifamily, you live in one and you have two investment. So the 1031 can happen on these two-thirds of the exactly. 1031, one is primary. So we can prorate it.
Are you limited on the amount of?
No.
It's your first example with the primary home. So if I 1031 to a property, $200,000 gain, and then I sell, can I do another 1031
Yeah.
with those proceeds?
Yeah.
Right?
You keep rolling at 1031,
250, increase by another 250, so that's
Yeah.
500,000.
keep rolling.
Then 1035 that.
1031. Yeah. Yeah.
So in essence, I continue to 1031.
The idea is to keep 1031 until the last day in your life when you give it to the kids, inherited tax-free.
Piggyback on this.
Sure.
I was always under the impression you had it one time.
No. You can keep rolling. Now, dealer property.
We've got a question now.
Oh, sure.
Jacob, after you.
Yeah, okay, you're talking about the primary residence. What about secondary residence?
Same thing. It applies the same rule as a primary. The house that you live in it, whether you have 1, 2, 3, 4, 5 houses, it is your residence subject to the 250 capital gain exclusion for you and 250 for the spouse.
What do you mean? So you can live in multiple?
Yeah.
houses? You can claim this is my house?
No, people have a house. Again, if you have 2 houses in Jersey City, it does not make sense. If you have a house in Jersey City and a house in Florida, summer house, beach house, mountain house. Okay, you have the California house, New Jersey house, it's fine as a second or third house. Now, this is very important topic. If you are pushing volume of houses, you might be considered a real estate dealer. Okay, and a 1031 would not work for you. So basically, there's 9 factors in here, and the 9 factors, it depends on how frequent, the frequency, okay, the consistency, duration, the extent, and the nature of improvement, effort to sell the property, the use of business office, time devoted, the intent, income driven from these sales compared to the global income. So that shows, are you a dealer or are you an investor? If somebody is doing 2, 3, 5 houses versus somebody is doing 50 per year, that's big difference. Okay, once you exceed that volume and now that becomes your business, you might be considered dealer, and a 1031 is not going to work, and now you have to pay self-employment tax on this income. So be careful.
Quick question, Pishoy.
Mhm.
Can your spouse be on the LLC and still qualify for 1031?
Yes, but we have to file it as a single member LLC, because if a husband and wife owning an LLC, we can get it as a single member LLC as well. So we don't have to file a partnership return.
And what's the threshold for the dealer?
There's no 9 tests. So we have to, it's case by case basis. You have to study the facts. You have to look into all of these. But that's what the IRS looks at. Are you a dealer? Are you an investor?
Does the IRS look at if you 1031 to purchase a resident that a family member owns?
That might be disqualified because it's family related party, but we can get it qualified if we prove it's arm's length transaction and there's no funny business going on.
Meaning immediate family or extended family?
Any family related, it should not be qualified. Let me put it in a different way. The IRS loves to audit this stuff. A 1031, a lot of audits on a 1031 happening, post-COVID especially, okay? And a lot of, if the family related, you have to be very careful if it's family related, because it's not an arm's length transaction, especially if he's discounted the price of the house or we're increasing the price of the house, it's not fair market value. So unless we have absolutes that this is no funny business, then I would go for it. So make sure it's valued correctly, like all of that, you know, documents are in order. Sure.
Other than inheritance, is there other ways of clearing the capital gains before you die?
Yep. Coming up. Next is rental multifamily. Again, maximize your expenses. Do not leave money on the table. A lot of clients and a lot of people, when they file their taxes, they do not look at all the expense sheets. We have a very expensive, very extended expense sheets for investors and for real estate developers and for rentals. So if you need it, please reach out to us. We'll be more than happy to share it. Make sure there's no item that you miss, okay? Now, the number of days rented and available for rent, crucial. Why? Expenses stop. You cannot deduct expenses if it's neither available for rent or rented. Available for rent means a tenant left and you have it advertised, okay? In an IRS audit, if the tenant if there's no tenant, no rent, and you want to expense it, you have to prove to the agent that it was listed. The agent want to see the MLS listing. I want to see who's that you're actively looking to get somebody in it. If you're not doing neither, the expenses will be denied. You cannot expense whatever you spend. During construction, that's different because we can capitalize this expense and everything. So,
Sure. Before we get a bit further ahead,
Sure.
Someone wants to know if you can further define the 9 factors of dealer.
So basically, again, the 9 factors, it's looking at how much your time into this. Is this your true business? Is this what's your income percentage that's driven out of this business compared to global income? How much hours devoted to this? Is this regularly, frequently? How often do you do this work? Is this day to day? That's what you do for a living, or you do this on the side? So if, again, think about it this way. If you need $100,000 a year to survive, how much is the fix and flip will give you out of the 100? If it's over the 50%, then we need to evaluate That's serious. Now you are dependent on this business versus it's a hobby next to my work. So,
I have a follow-up question.
sure.
So I think a lot of us kind of fit that category here.
Yep. But how much, what's the volume? Now, if you are getting a property, okay, and you're wholesaling it, versus you're getting a property, fixing it, spending, you know, a month or two on fixing it and then listing it. That's an investor to me. If you're buying the property and you're wholesaling it, that's a dealer. Okay, you see what I'm saying? If you're selling 5 to 10, I would argue that's an investor. If you're selling 50, I'm going to argue that's a dealer.
So KH Opinion and Toll Brother are most likely like dealers.
Say again?
KH Opinion and Toll Brothers and all these companies are most likely.
Yeah, they're dealers, they're developers. It's different situation, okay? Because they produce mass volume. That's their business. It's ordinary. The idea between investor and a dealer, an investor can treat it as a capital gain. You get the lower rate. A business like Hovnanian is a dealer where he gets it as an ordinary rate. There's no capital gain. So he pays the 37% versus you, an investor, you pay a 20%. That's the whole difference. So we're trying to qualify you for a capital gain treatment to keep you as an investor for the lower rate. All right, next. The 14-day rule, we went over this.
What's what if you want to be a dealer?
You can.
Yeah, but you're gonna stop with the 37%. It's no incentive.
Yes. So there's two rules. If this is your day-to-day business versus this is an investment. An investment, you qualify for the capital gain. If this is, okay, it's no longer investment. Now I'm 100% into it. That might qualify as a business. It's no longer an investment. And a business gets the higher rate, an ordinary rate. During construction, we just went over this, that during construction, you can capitalize the expenses. Now, this is very crucial, the passive versus non-passive. There's 4 tests in here. What do I mean by passive versus non-passive? As long as you have income, the IRS does not care. The rules kicks in when you have losses, when you want to offset losses against income. One property have a loss, and you have a W-2 job. I have income from my W-2, and I have a loss from rental. Can I offset that? And that's where the rules kicks in. Okay. Number 1, non-active. Non-active means you do absolutely nothing. You put money in a rental, and you did not do any work on it. Very minimal. Passive. So that means all your losses are limited and carried over. So every year you lose $5,000, $10,000, you just carry over until you sell when you realize all of these losses. Or if future income comes from this property. Okay. Number 2 rule, active. Active participants, that means you are a 10% owner, minimum 10% owner. If you're under 10% owner, you're non-active. Active means you are a 10% owner and you cannot be a limited partner and you're doing some kind of work. And therefore you can deduct $25,000 maximum losses from the rental of real estate against your other income. Third is your material participation is 500 hours, defined as. Again, there's more to it, but the highlight is it's 500 hours that you devoted to this business, 500 hours. And now you're a real estate professional if you spend over 750 hours in the business.
How do you document that?
A log. Basically, you have a calendar and you go to pick up checks, you go pick up the rent, you go pick up mail, you pay your bills, garbage day, whatever you have to do. Maintenance, cleaning, repairs. So that's a log.
And does it have to be on site of the actual property?
No. No.
So it could be from a home office or?
Because you're paying bills, you don't have to go to the location to pay your bills. So.
Quick question from the chat, Pishoy. Can you draw a salary for your work on a fixing floor?
Yes, but it's not the best idea. And salary is a very expensive word because salary is subject to federal tax, New Jersey tax, self-employment tax. So you pay an extra 15% self-employment on salary versus a capital gain, you pay 20%. So why would you escape the 20% to pay yourself salary so you can pay 45% on it? So I'd rather keep it as capital gain without drawing salary. But yes, you can.
So if you own a company, you better off just work, don't pay yourself salary and just capital and everything.
Again, it depends. No. Everything has to be reasonable.
I own a construction company,
A construction, you have that's an ordinary. That's not capital gain.
but I broke it salary every month. So
That's fine. That's great. Construction company, you need a salary. That's ordinary income. There's no harm in this, and you have to draw salary.
So this contradict with capital gain.
Capital gain means you buy a house, you flip it, and you sell it, and you made a $50,000 gain as an investor. Why would I take that lower tax rates that the IRS is giving me and say, thank you, IRS, let me pay myself salary to pay 45%? If that IRS is already giving you a 20%, why would you say no? All right.
That's running a construction company as a developer, right? You have 1, 2, 3 construction LLC.
Yes.
So ideally, if you find another development, you're gonna open up a separate entity, hire out a construction company. That's probably, is that the best way to make sure you realize just capital gains tax on that deal? And that way
It's-
the construction company.
Again, true, it's different because it's not under the construction, yes. So you have to do it in a separate LLC to protect the assets. But at the same time, you have to make sure how many are we doing? Am I considered a dealer or no? Because a lot of construction companies, they start doing their own dealing. And they got themselves to be qualified as a dealer, which is fine because they're pushing volume now. So because of that volume, they qualified as a dealership, as a dealer, and therefore they disqualified themselves from the capital gain treatment. That's all. So you just pay the higher tax. You're not doing anything wrong, but our job is to reduce taxes, not increase taxes. So it's just some planning into it, that all what it takes. Sure.
Qualified as a dealer, if you move maybe 15, 20 houses as far as selling. But if you do 15 houses a year, you sell 8, you keep 7, you're not dealing.
It depends because not all dealers have to sell everything at once. It's a rolling. So they're looking at multiple years. And what's your income driven from this compared to other income? What's your hours driven here compared to hours for outside work? So everything has a different, we have to evaluate case by case, basically. There's no set rule. There's 9 rules, and we have to play with them to see, are you qualified or are you disqualified?
So do you present that decision as the tax preparer when you say?
Yes.
I believe my accountant years ago, something similar to being professional and part-time.
Yes.
That was my first year when I was 25. I got hit for some decent amount of taxes and said, don't worry about it going forward, because now you're going to be deemed professional. Now you're going to be able to get all your expenses accounted for as you could before.
Exactly.
So basically, you make that case when you submit the taxes, and this the IRS will come back and say, hey, you want to audit you. We think you were this, then between my tax preparer and the IRS determine what I am.
Yes. So basically, when we prepare taxes, and a taxpayer comes and have multiple houses for rent, we have to determine which case is he, and does he have the proof to get you as a professional? If you're a professional, then you're good. It's your business. All your expenses comes in. All your income comes in. If you are or maybe you're not professional, you're just material, which is the 500 hours, and get you qualified this way. So every case has a different, and we have to run through this test every time. If you're talking about capital gain deferment and savings before inheritance, to answer your question, here you go, the opportunity zone. If you buy a house, a real estate in an opportunity zone, and you leave it for 5 years, you get to increase your basis 10% of your gain. So You buy for 500, now it's worth $1 million. There's 500,000 capital gain. I can take 10% and increase it to my basis because it's an opportunity zone. If you wait 7 years, you do the same at 15%. If you wait 10 years, you get 100%. So you can sell it after 10 years, zero capital gain, if it's opportunity zone area. And how to know it's an opportunity zone? There is a tool on the website, on the iOS. If you can put your address of the property, you can evaluate. And it will tell you yes or no. Again, the opportunity zone is going to be more of economically challenged areas. So
But if you're investing in an opportunity zone, is there a way to share a percentage of your entity ownership to another investor to avoid transfer tax and give them basically, let's say you had the development for 2 years, it's stabilized after 2 years. You own, as the developer, 50% of that development. Let's say another investor comes in, you can actually share or sell a percentage of your entity to that investor and avoid transfer tax in that way, while also providing them the benefit to have 2 years into that 10-year life cycle of the opportunity zone.
yes and no. It's again deal by deal. You have to look at the details, but from the outside, yeah, it looks very good. But because you're not buying a real estate, you're not selling the real estate, you're buying into the shares of the owner of the partnership. So you're not selling the actual real estate or buying the real estate, you're buying into the business that owns it. So it's different structure. So yes, there is a possibility, but it's case by case. We have to evaluate.
Is this for short-term and long-term capital gains?
10 years. Short term is under 1 year. So this is all long term. You have to wait 10 years to get the 100% basis.
So meaning the initial capital gain, I'm reading this as, let's say you had this capital gain, you roll this into an opportunity zone, you keep it in there for 10 years, you pay no gain.
No. If you already have a gain, that's different conversation. Now, you come in today, fresh money, you buy this for $5 million. In 10 years becomes $10 million. You take the $10 million and say, thank you, IRS, zero capital gain.
Is 1031 will apply to all here?
Why would you do 1031 if already got 100% capital gain, deferred, zero, taxes, out?
Okay, so I still have to raise a
So, like the idea of 1031 to defer it, but if it's already deferred,
Well,
Yeah.
from a 1031 sale, you can invest in opportunity zone.
Yes.
Here, not pay that 1031.
exactly, but
you'll still pay.
you still pay the initial deferred gain. The initial deferred gain is still going to be paying on it.
So good deal because inflation is going to be nothing.
Yeah. Cost segregation. Why people do cost segregation and what's the advantage of it? Cost segregation is we're trying to utilize the depreciation as a tool of expense. Expense today, and let me pay on it in the future. Depreciation, when you come to sell, there is a deferment, it's going to be recaptured by 25%. So if you're in higher percent bracket, 37, I would do depreciation, reduce my income, pay on it lower, okay? And then when you come to sell, the depreciation will be recaptured at 25%, part of the sale. It's fine. So the idea of you buy a building, let's say $1 million, and we hire this company, so that if we depreciated the $1 million commercial building, it's going to be over 39 years. Okay, so I'm going to take $1 million divided by 39 equal, and that's my depreciation. If I did the cost segregation, they're going to come in, engineers, and they're going to say, okay, the plumbing system is going to cost $100,000. The electric system, $100,000, and they keep segregation of all the different parts of the building. So now I can take this 100 and divide it over 7 years, not 39 years. So now I have a bigger depreciation. So I don't pay any income on the income right now for the next 7 years or 10 years or 15 years. It depends on how much this depreciation will last until it's fully consumed. Now, when you come to sell, this depreciation gets recaptured at, again, 25% tax rate.
So what's the difference between depreciation and segregation?
Segregation, basically, you're taking one building
Breaking down.
You break it down into items so I can depreciate it. Okay?
What depreciation and depreciation for 10 years it should be equal, or would you say
No. So basically, let's say it's $1 million. I'm going to take it over 39 years. But now when I did segregation, I took almost half of it and I divided it over 5 and 7 and 10 years. So now I accelerated my depreciation. It's the same value over the 39 years, but I took most of it in year 1 through 5, where I'm building the business, when I need the cash, and then I left the taxman, you know, start taking the money year 10, 11, and 12, and so on. Now, section 179 versus regular depreciation, same concept. I'm accelerating my depreciation to take it now, then next year. So section 179, you buy a car, okay? You expense the car today, or do you want to expense the car over the next 5 years? It's the same value, but shall I take the expense today or the next over, let's say $50,000 today, or 10,000 in the next 5 years? So that's the difference between 179 and regular depreciation.
When you sell, you're going to be taxes for it.
It's going to be recaptured when you come to sell it at 25%. But again, if you're renting, you don't have a choice to depreciate or not to depreciate. You have to depreciate, because depreciation recapture will happen regardless.
The question is how long you want on.
Exactly. So
Technically, you can do cost segregation, depreciate over 7 years. If you buy an opportunity zone, at 10 years, you took all the depreciation, most of it.
Yes.
Plus you got all the capital gains.
yeah, but when you come to sell, the depreciation will be recaptured. The capital gain will be tax exempt after 10 years.
So the depreciation is not.
It's not going to be forgiven now, because depreciation, you took it away from the ordinary. So it has to go back to, yeah.
But only at 25%.
Exactly.
Pishoy, does this make sense for properties under 500,000 or only really for properties of higher value?
Again, it depends, but it depends on the case-by-case situation. Depends on the costs. How much is a cost for the cost segregation compared to the benefit? So we have to do cost analysis. And if the cost, basically, if the company will charge X amount of dollars, but the benefit is 2X, it makes sense, or 3X, it makes sense. But if the company charges 2X and my benefit is 1X, it does not make any sense.
One more question. Is there no way to defer the cost segregation in the sale, even if you 1031 exchange the sale?
If it's 1031, it's deferred. The depreciation is deferred in the 1031. So once you do 1031, but on the exit, after all the 1031 is done, and now I want my money, exit, everything would be recaptured. So capital improvement versus repair. What qualifies as a repair, as an expense? What qualifies as a capital improvement? Big question. And the reason is, what's your intention? Are you fixing the roof or you're changing the roof? That's the question. If you're fixing the roof, it's cost $2,000-$3,000. Maybe that would be under repair. If you're changing the roof and it's $20,000, that would be, I would argue, this is capital improvement. And the reason is, this is going to benefit multiple years, not 1 year. The repair, it's a routine, preventative, maintenance. Capital improvement is something you do it once, like, for example, you take the house and you put new sheetrock and new walls and new plumbing. That's capital improvement. But you paint, I would argue paint is repair.
And this is tax.
That's tax deduction. That's expense.
But if you charge a customer, you charge a tax.
Yes, exactly. But that's on the construction side, not on the, yeah. Okay. Capital improvement is tax exempt, sales tax exempt as well.
So the capital improvement,
Yes. Capital improvement, you capitalize it to increase your asset. You don't get the benefit of it immediately unless you depreciate it, section 179. But basically the idea that you increase the basis of your asset and then you start depreciating over a period of time. If you selected 179 accelerated depreciation, you can expense that in year 1, depends on the class of asset, of course. Self-directed IRA. Great tool, be careful. Why am I saying that? Self-directed IRA. A lot of people put money in an IRA and you invest in the stock market. Fine. Now, stock market is doing well, stock market is doing up and down. I don't like the financial advisor, I want to do it myself. Great. They move it in a self-directed IRA. And now they go buy a house with this money. Imagine you have $500,000 in a self-directed IRA and you go and you buy a house. Okay. First mistake, do not partner yourself with your self-directed IRA. You cannot touch it. Your wife cannot be a partner with your self-directed IRA. It has to be a complete stranger. It cannot be a household, cannot be related. Okay. If you're going to go in a partnership, your self-directed IRA has to be partnering with a stranger. It cannot be in relation. All rental income and basically what we do is we open a checking account to the self-directed IRA. Rental money does not come to you. Rental money goes to the self-directed IRA. The rent checks is payable to the self-directed IRA. Your tenant pays the rent to the self-directed IRA. Your expenses goes out of the self-directed IRA. If you paid one bill out of your personal account because of convenience, disqualified. Be careful. If you ran, you got one utility bill and you just put your personal credit card versus the self-directed IRA account, you just got yourself disqualified. And the entire amount deemed to be distribution to you, the entire $500,000, as if you went to the 401k and you put $400,000 or $500,000 taxable. So be careful. It's a great tool, but it has a lot of red tape around it.
And when you say stranger, that means it also cannot be an entity that you own?
No. It cannot be your accountant, cannot be your lawyer, cannot be somebody that you've done business with. Like a complete stranger. So be careful. And that's why a lot of people do it, and they do it 100%. So you buy the house 100% with the self-directed IRA, but that's fine. But income and expenses in and out has to be 100% funded through one account. It's the self-directed IRA.
If you're raising LP capital from a limited partner.
Yes.
Development, and look at the doctor, dentist, something of that nature, they obviously, they have to work with quote unquote stranger. So if they're investing passively into a development, right, or into a rental with one of the investors out here, can they still structure it that way where their self-directed IRA funds part of the equity investment?
As long as it's part of a group and they have no control over it, that's fine.
So one of the developers in this room can basically raise limited partnership capital from somebody's self-directed IRA. Who is still
I don't see why not, but again, the take home is every rule has an exception. And everything we're saying, again, I'm just touching the surface. There is a lot of exceptions and a lot of do's and don'ts in everything we mentioned today. So speak to your accountant, speak to your professional advisor, get to know the details before you put yourself into harm's way and it's too late to fix.
And what happens if you make a mistake and you reimburse an expense?
We have to speak to the self-directed IRA company how to fix it and how to mitigate it. So gift versus inheritance. Great tool for estate planning. The first $16,000 individual to individual can be tax-free. I can gift each person $16,000. Each person can gift me $16,000. There's no tax. Even between you and your kids. You want to give $16,000 to first child, second child, third child, and then your wife does the same, 16, 16, 16. There's no issues. The minute it exceeds 16, we have to file Form 709, which is a gift tax. A gift tax, where you choose either to pay the tax or to exempt it out of your life exemption of $12 million. Again, believe me, $12 million is not a big number. A lot of people exceeded that number, and we're dealing with a lot of issues in here because one building or two buildings or like a few $1 million each, boom, market appreciated, and you're in the $12 million. add to it life insurance, add to it other investments, $12 million for you, $12 million for your wife, $22 million. If you do not have that issue, great. If you do, we need to start talking about estate planning, because the IRS will take a big bite if you exceeded this number. If somebody passes away and the real estate in their name will get step up in basis immediately. So we get the value of the house or the property on the day of death. And that is, your kids will get this today at this market value. So if you bought it for $1 and now it's worth $1 million and the kids inherit it, the kids get it at $1 million. If they sell it, zero capital gain on it. So the idea or the best strategy is to keep 1031 one after another until you grow a good size investment. And then here you go, you keep it in your name, the kids inherit it, goodbye. That's the best situation. Of course, that's textbook. No, in practical life, stuff happens different in this situation.
I have a question about that. So like you keep snowballing the 1031, right? And to pass it on, you have to roll it into a trust, or what structures, what do you offload that into?
You can basically, let's say you have 5 houses now, you sold this 5 and you bought 20. And now your portfolio has like 50 doors, 100 doors, whatever the number is. So you own all of them personally. Then whenever something happens, it goes to your heirs, and they inherit it tax-free. Okay, you do not need a trust for that.
Okay, I thought that was taxable.
No, when it's inherited.
Okay.
Okay, when the owner passes and the heirs inherit it,
Yeah.
that's tax-free. It's taxable if you exceed the $12 million per person. So you have 12 and your wife have 12, you have 24.
Then the kid has to pay tax.
Over the 24, your estate will pay the tax.
Right. So it's still taxable.
It's taxable over $24 million
Oh, and this number change every year?
every year, inflation adjusts. And it's supposed to go back to $16,000, something like that, in 2025. Because it's just the extension was until 2025. So it resets unless the Congress extended again.
Send it from 12 million to what?
So basically the tax codes, it's never permanent. It's always extended. And they sign a bill to extend it. And it's been, for the last 50 years, it's been getting extended every time. So I'm sure it's going to get extended again, but it's set to expire in the year 2025. Basically, they do it this way so they can evaluate what's the market recall at this time.
So this 12 million can increase or decrease?
Yes. So it's set until 2025, until today. So
On an inheritance basis, the properties are valued at market. On a gift basis, are they also valued at market?
no, they get it at the basis of the donor. So I buy a property worth $1, and today's $1 million. If a person dies and the kids inherit it, they get it at the $1 million. If he gifted before he dies, they get it at $1. So he gift the basis versus inherit at death, they inherit the fair market value.
I have a question with the example. Can you, in essence, use the gift exemption to defer capital gains? Like
No.
if I made 30,000 on a deal, can I give 15,000 to each child and then not pay taxes on gains?
No, the gift is not an expense. You cannot expense gift. But if you gift it, basically it's non-taxable under $16,000, but it's not an expense. So no, you cannot offset that now. Any questions?
Sure, are there ways to, over the $24 million range, are there ways to shelter the estate tax?
Yes. Now we have a lot of estate planning to do that, and now trust kicks in, and different values of trust and different tools are available to get away with that. So yeah, there's a lot of techniques, but that would be a totally different topic. So, all right, with that, I'm going to conclude. Thank you so much for listening. I'm sorry, go ahead.
I have a question. If it's not a deduction as far as its expenses. However, if you do a donation to a church,
That's a donation to a church.
that's a 501c.
It's three. Yes.
That's already qualified, so that's
That's a deduction, but a deduction up to 60% of your income. Okay, so it has a limit. And if it's a 501c3 nonprofit, not church, it's limited to 30% of your income. So there's different rules, you know, like, are you donating to a nonprofit or are you donating to a religious organization? Yes, but a religious organization has a higher limit than a nonprofit. That's all. Okay.
Also have a question for properties. That was the first one that you were talking about. What about Airbnb? We just started now, and we have like regular rentals, apartments, but we started like beach house with Airbnb. Would that be the same thing as far as the deductions on that?
Yep, same thing. Now, keep in mind, I'm going to go back to the slides because the Airbnb, if you use it more than 14 days, personally, use over 14 days, you cannot generate a loss from it. Okay, so any property, if you are renting 100% and it generated a profit or a loss, you can claim this income and expense. If you're using 14 days or more, personally, then that disqualifies the loss. You cannot generate a loss from it. Okay. But if you are using only 14 days, then it's a normal rental property and you can offset against other rental income and expense. Gets into the mix. Yeah, so as long as you personally are not in it 14 days, more than 14 days a year.
What's the determinant of property rentable or not? If you would buy a property to demolish and build, can put it in 6 months as a rental, nevertheless, and you don't rent. It is lawful.
Now, the IRS would evaluate that it was a shack and now it's a building, and it did not happen overnight. Like this happened in construction period.
We carry property for over a year.
Yes.
Sometimes it's sitting there.
Exactly. And that's what I'm saying. Can you list it? What's your intent? You have to prove intent. Okay. So that's what the IRS is looking for. If it's listed, if it's money for market value, how many people came to see it? You have to prove that I've been actively trying to rent it. So just having something listed and I'm rejecting every single person who walks in, that would be that's not right. Yeah.
Question on bonus depreciation. So if I'm raising capital and now a bunch of surgeons that want to invest with me as an LP, typically only active investors, active real estate professionals can use the active bonus depreciation over the entire tax return. How do you get them to?
Limited partners, it's always going to be passive. Zero losses. They cannot harvest loss. The loss will be carried over. If it's limited partner, you have to be active in order to get the expense.
So on that, so now that's a great question on bonus depreciation.
Sorry.
Limited partners, they can't actually use.
Can we get the screen?
Let's say cost segregation, right? And
Yes.
you have X dollars of expenses. They can't even write it off against their passive income, like let's say dividends and stocks.
No. If it's limited, let me get to the slides.
K1, then
Can you keep going? Say again?
So if I invest in syndication, and my K1 is negative.
Keep going.
Right, so I can't take advantage of that.
Yeah. So let me show you the slides. Next. That's it. So if you are a limited partner, that means you have zero activity. There is a lot of rules comes into your losses. So the idea of yes, you can take it or no, you cannot take it, depends on you, the personal income tax, individually, case by case. Okay. The rule of thumb, without discussing details, it's not deductible, it's carried over. Can person have an exception in their case and deduct it? Yes. Okay. We can talk about that off air, but what I'm saying is this is the rule of thumb. If you are active, you can take 25,000. If you're material, you can take unlimited. If you're professional, you don't have to even apply the passive rules for you.
So most of the investors here are full-time professionals.
Yes.
They're flipping properties, they're developing, they're selling. I mean, a great way to shelter gains is basically invest, let's say, a multi-family syndication, and that they can take that bonus depreciation over, let's say, 15 years from year one, write it off against all their earned income as developers. They can do that.
Yes and no, because that's the beauty of the tax code. There's always like the rule, and you see like 5,000 pages of exceptions. So the idea, yes, but now, how many, in order to get a real estate qualified, how many properties are you renting? If it's one, now, even imagine if you're a real estate professional, you're doing flipping, that rental, do you qualify on that rental as a professional or no? Because it's case by case, and it's not matter of your ultimate real estate professional, no. It's rental by rental. So if you have 10 rentals, I have to qualify you on all 10 rentals, and I have to file an election to look at these 10 rentals as one unit. Because if we do not do this election, the 750 hours will apply to each address. So it will be very hard. So what I'm saying is we have to look at each unit by itself, standalone, and we do the test. Or we can group it to offset that rental against your ordinary income. So there is a lot of planning in here. It's not set it and forget it. It's an every year election. You have to evaluate on an annual basis. So there is a lot of exception to the rule, but that's the highlight. That's the idea. So what I'm saying is today is not a do-it-yourself income tax. By all means, it's the opposite. Today is just this exists. Speak to your accountant, speak to your professionals to advise you properly. Okay.
And on that deduction, that's up to 25,000 for each property.
Yes, 25,000. Again, if you're active, depends on each property. Yeah. All right.
How would you calculate the hours? 750?
Log. You need to prove it. A log.
Yeah, no, but how would you, is $200 an hour, is $100 an hour, like what's the value?
No, there's no value. There's no dollar. It's how much time are you investing in these to maintain this property? How many times do you go to clean, to repair, to paint, to remove the garbage, to pay the bill, to collect the rent? You need to log what's your timesheet.
What I'm saying is active has $25,000.
No. This is up to, you can limit your losses to 25,000. And to answer your question, I'm sorry, the 25, I misunderstood. The 25,000 is for the taxpayer, all the properties together, not per property. Okay, that's for the person, for the income tax. If you lose, for example, $100,000, if you're active, you're only gonna take 25,000. Okay, and the rest carried over. If you are material, you're gonna take the entire 100. If you're professional, you will take the entire 100 loss against your other income.
What is the percentage? 100%, 50%?
100% expense. So you lose 100 and you made 100 from a different business, you can offset against each other and become zero.
All properties, not the one.
Again,
You have to bundle them.
you have to bundle them to get you qualified. If you did not bundle, automatically the test is applied per address, per location, individually. So if you did not do the election, you're going to be out the 750. Okay. Thank you so much for listening and for coming. I appreciate it. And if you have any questions, I'm going to be around. We can talk after. Thank you.
Thank you, everyone, for coming today. Thank you, Zach and ABL. For the people that are online, we will be sending out a recording to you, as well as everyone in here. We've included folders for the people that are live, which we will send out also to everyone online. Our website is pnfcpa.com. If you have any further questions, again, my name is Tanya, and I'm happy to help and set up a call or whatever you might need. Thank you.